my Zoom screen. Anyway, so tonight, there's no class next week. Thanksgiving, whatever you want to call it, fall break. So I've made a change to what we'll be doing. The sampling exam is probably takes the longest to do. So I'm going to move the sampling exam up before the chapter 7 exam. So we'll finish up finish the sampling practice exam. And tonight I'll send out the sampling exam, which we do a week from Friday. And we should be able to finish chapter 7 internal control. There's not too much left there, but I think we'll focus on the sampling, and if for no other reason, just to get this thing done. The first assignment we had in this class was sampling, and here we are, week 12, and we're still, So anyway, so let's pull up. Thing. Yeah, we'll go to classical sampling. We'll do pretty well on classical sampling, usually, unless it's a math error or something like that. But for the most part, classical sampling people do pretty well on. So we'll go through it.
Professor, did you email us that, or have we started that one already? I can't.
We started it already. I did email it though.
Oh, you did? Okay. I just want to find it. I don't know.
And it should be in. Let me see if it's in Blackboard. It should be in Blackboard. Doesn't mean it is. It should be in Blackboard. And last time we just got through the yeah, it's in Blackboard too.
Oh, yep, I got it. Thank you.
Yeah, we got through the this is one that a lot of people missed, the test of controls. So that's why we went through that one first. But classical sampling, people usually do pretty well on this. I think it's probably the most intuitive of the stuff that we do here. Okay. So what we're going to do is, and by the way, this is kind of the way you'll see it on the CPA exam when they have tested it. They've given something similar to this on it. Okay, we took a sample size of 1,000, and here are the audit values of the samples. So if we want to get it into a average, to divide these by 1,000. The average audit value would be $50. And do the same thing over here. If you're lazy like me, cut and copy. As a cut and paste. 48. I think I told you guys this, but the CPA exam used to have, you couldn't use calculators on it. So there'd always be like nice big, round numbers like this that'd be really easy to do. You knew if you got some weird number like 5.372, you did something wrong. All right. So the average audit. Oh, well, let's try this again. This is wrong. The average audit value. I'm just going to copy the whole thing. And so this is what we're going to use to project over the entire sample to see what is misstated and what is our projected misstatement and our projected value for the account. So they have these accounts receivable on the books for that. And we want to see if the 380,000, whether that is fairly presented or not, basically. Okay, mean per unit. Mean just means average. And as you recall, we like our average better than somebody else's. The audit average, this is what we did. So we have more, it's more persuasive than what the client gave us. The client gave us this. When we did the calculations, we came up with 50. So that's what we're going to go with. So mean per unit says that every item should have a value of, oh, let's try it again. Okay. $50, and this will give us our projected value. So $50 times 8, what is it? 400,000. So $50 times 8,000, 400,000.
400.
Okay, so it's 400,000. So this is our projected value. Whoops. So we're saying everything, all 8,000 items should be the same as what we came up with. So this should be, the total is 400,000. So this will be the projected value. And we're going to compare that to the book value, what they have on their books. And so we will have a projected misstatement of $20,000. Okay, is that an overstatement or an understatement? Anyone? We're saying it should be 400,000. They have it on their books at 380, so it's missed by 20. Sorry, someone?
Understated?
Yes, good. They're understated by 20. You know, we're saying they should have 400,000. They only have 380. So this is, the 380 is understated. So we talk about understatements. This is what this is what we're talking about. This is what's understated. Oops. So the 380 is understated by 20,000. Okay, ratio estimation says that everything is off by a ratio. And my 2 cents is that I think this is probably the I think theoretically maybe the one that applies to more situations than the other two. Okay, so let's take the audit average. I'm gonna copy them. So audit average divided by the book average times the book value. So take 50 divided by 48 and then times it by 308,000. And that's it basically saying everything is off by the same ratio, that large items are off by large amounts, small items are off by small amounts. And I'm just going to round it off to the nearest dollar. 395,833. That's right. 395,833. Okay. All right. Let's see here. Eh. Okay. That doesn't look very good, but anyway, so the projected misstatement would be $395, that'd be 15,000. $833. I think you may want to check that, make sure. Okay, so this would be same as the other one, right? Understatement. We're saying that it should be 395,833. You may want to check that number, by the way.
That number's correct.
Is correct. Okay, thank you. And then so this would also be understated. They only have 380. We think they should have 395,833. So this is understated. If anyone misses one, it's this one. And this one, I shouldn't say it. Sometimes people miss this one because of the whether it's overstated or understated kind of thing. And you got to think about just the item itself. So difference estimation just takes the difference between these two. Now, before we even get started on this, before we do any calculations, is this going to be understated or overstated? You can actually figure it out before you even do any of the calcs. Well, we're saying that everything should be 50, and they're saying that everything should be 48.
Understatement.
Yep, very good. Yep. So we know before we even get started here that this is going to be understated because we already think that it's higher than, you know, than it should be. This 48 is understated. Okay, so we're gonna take the difference here. And just subtract them. And we're saying that every single item that they have, every single accounts receivable is going to be off by $2. And they have 8,000 of them. So all 8,000 will be off by the same amount. And notice that that's kind of different than this one. This one says big things are off by big amounts, small things are off by small amounts. This one is just the opposite. It says everything's off by the same amount. So if it's a $10,000 account, it's off by $2. If it's a $10 account, it's off by $2. Okay, so this will equal, and this equals our misstatement. Projected misstatement. 16,000. So this one is also a little bit different in that, oops, it gives us the projected misstatement first. And we kind of have to back into the projected value. So here's a projected misstatement. It's an understatement. So how are we going to get the projected value? I have enough room here or not? Stuff going on here. Okay, so if there is a projected misstatement 16,000 and this is an understatement, their book value is 380. So what would be the projected value of the account? So if this is an understatement, that means we have to add it to it. So the projected value would be what, 396? 396,000, I should say. So you're going to kind of back into this number. And so that's another one thing that's kind of wacky about this one is this is the last number you get. And it's kind of like a plug number. So we're saying everything's off by $2. You have 16, you have 8,000 of them, so that's 16,000. And the projected value is 396. Question on that? Most people get this one, most people get right, and I think because it's the most intuitive one. There's not too much wackiness in this one. The last one's a little wacky, but and the methods that we use here for the classical sampling, these are the same methods that you can use for anything. You know, you use for the size of whatever size of lake trout in Michigan, Lake Michigan. Okay. Monetary unit sampling, and I did not do something very smart here. I should have put this table up, and I'm going to copy this table, and hopefully it fits. I don't need that. Okay. Probably won't, but we'll try it anyways. Okay. So here is our, unfortunately, by the way, on the test, I give you the sample size the same way it's on the handout. So it's easier to use. So on the exam, it won't be. I don't know why I didn't do it on this. I did go in and change it today. It's not going to help you guys, but sorry. So anyway, so this is the sample size calculation. So we'll take the total population times reliability factor, take the total misstatement minus, if the people get wrong, it's down here. You got to subtract the expected times the expansion factor. Okay. So sample size. Give me 1 second here. Okay. So we're going to take the book value times reliability factor. Times reliability factor. Now this is at 10%. So I'm going to come down here to 10%. And for sample size, we use row 0. So 231. Coming down here, tolerable misstatement, oops, is 30,000. The all-important minus the expected misstatement times the expansion factor. Yeah, on the test it'll be up there, the expansion factor. Nice thing about expansion factors, there's just one. Whatever, whatever the percentage is, there's no multiple rows or anything. Just that quick, I forgot. 1.5. Okay. $1,155,000. Let me go back here.
That's correct.
And down here. It's usually easier for me to just do that first. So, and then subtract it out. Oh, with 1,800, 30,000. Minus 1,800. $28,200. Oops. Uh, 41. I had 40. Oh, what did I get? Erased it. No, I didn't. 40.95 or 40.96 or something like that. So rounded up. I think I told you in the past I was rounded up, but the true formula is that you round it to the nearest item. So anything up to 0.5, you round down, and if still 0.5, you round up. I think I don't. So I would just round it up just because it's one more item, and if you want to go into court and say you round it down, there's a problem. But regardless, I'll accept it either way. So if you round off the nearest number, which is the true way to do it, that's fine. If you round it up, that's fine too. And this one, it would be the same either way. Okay, so sample size 41. Is that what you guys got, by the way? Hopefully.
Yes.
All right. And the interval is the book value divided by the sample size. Okay, so the interval is, I'm going to do it on the side here. 500,000. By 41. And I would just round this off to the nearest dollar. It doesn't, if you leave it whole, that's fine too. The pennies and all that, that's fine too. 12,195. Okay. A sample size, and the sample size is it's important for a number of reasons, but it does two things. It first of all tell you how many items you're going to pick, but it also tells you which items to pick. Because remember, we do this interval, and every item that passes this interval we pick out as representing the entire interval. So the first one that crosses 12,195, that's the item that we pick. The next one that crosses what, 24,390, that's the one we pick, and so on and so forth. So it also, this sample interval, this is what picks the sample for us. So the sample interval, this actually picks the items for a sample, which is very nice. You have to look at a random number table and do all that kind of stuff. Okay. Now for the ugly one. And monetary unit sampling, it can be kind of quirky. The risk of incorrect acceptance, 10%. Book value, 400,000. Okay. This first one is one where most people, if you trip up, it's going to be here usually. Next, we get all these wacky rules for it. Okay. Now let's just jump in, see if anyone can figure it out. There's something funny about the first one. What's funny about the first one?
The book value and the audit value dollar amount, is it the audit value is higher than the book value?
Yep. Yeah, it's not supposed to find these. This is an understatement. The monetary unit sampling is basically for overstatements. So this one is overstatements only. So much so, goofed up spacing. So much so that when we run into something like this, this is an understatement. We ignore it. Projected misstatement is 0. It's not misstated at all. And as auditors, that kind of rubs you the wrong way. You find something that's clearly not right, but you ignore it because it's not supposed to find those. Now, the second one is a well-behaved one. We can just do that one the way we normally do it. It's kind of it's sort of like the ratio one. You get a ratio for the entire interval. So 20 divided by 200,000. I said 20 divided by 200 times 5,000. That is
500.
Okay, so that's the projected value. So what is the projected misstatement? So of that interval, 500 of it's okay. So how much of it is not okay? The rest of it, 4,500. And so this is the normal kind of ones that we find. This is the normal, what that you're looking for that you usually come across. And by the way, this is an unhappy coincidence. This being 4,500 and that being 4,500, those are not related in any way. I should redo this. I will redo that one. It's hard making up handouts and stuff because we're humans. We always try to make sense out of something. So you look at something and go, oh well, these two numbers are the same. They must, and sometimes it's not like it. So you gotta be careful when you're making handouts. I'm telling you this, I should be telling myself this, but you gotta be careful because you can come up with these problems. But anyway, this 4,500 and this 4,500 are two different things. Okay, now this one down here though is a wacky one. What's wacky about this one? The last one here.
The book value is higher than the interval.
Yep. The book value completely covers the entire interval. And when that happens, we take the actual rather than the projected misstatement, because the actual will actually be higher than the projected. And truthfully, I'm more honest than the projected misstatement. Now, this is why we do this method, though. If the client overstates an account enough, it's absolutely certain it'll get caught, because if it gets bigger than the interval, like this one is, this was 100% certain that this one would be caught because it's bigger than the interval. If they left it at 4,500, it may not have got caught. Or if they only moved it up to 4,600 or 4,700, it may not have got caught. But the second they go over the interval, it's absolutely sure it's going to get caught. So we just use the actual misstatement for this one, which is 5,500 minus the audit value of 4,500 equals 1,000. So this, the projected misstatement would be 1,000. Yeah, I'm gonna hold off on the incremental. I'm gonna hold off on that. We'll do that when we do that over at the bottom. Okay, so the projected misstatement here would be okay, 5,500. I got all kinds of unhappy coincidences here. These all together. I'm just going to redo this one. This is the one that's causing all the problems. I'm going to redo that next time. Okay, so this is our projected misstatement. This is our best estimate as far as what this is off by. So if someone were to tell you, what's your best estimate as far as what these are off by, you'd say 5,500. Now, it is a sample, so it might be off by even more, but this is our best estimate. Okay, basic precision. I'm gonna copy this. Oops. Oh, it's centered. So basic precision equals our interval. So what's our interval?
5,000.
Yep. Oh, that's a little more than our interval. Try that again. Times the reliability factor. We need to know this. Risk of incorrect acceptance is 10%. Okay, so 10%. Come down here to the table. Percent. Basic precision is at row 0. Oops, row 0. $2.31. $11,550.
Yep.
And now, and that number is if even if we didn't find any errors, if we didn't find any misstatements, it's still possible it could be off by 11,550 because it's a sample. And unless you take 100%, there's a possibility they could be off by more. And in this case, we're doing this with a 90% level, 10% risk of incorrect acceptance. So yeah, so this will be if nothing was found, you'd still have this precision. Okay, now the most irritating part, the whole thing. Actually, most people don't get these the incremental stuff wrong for some reason. More people miss this top part here. More people miss this up here than miss the incremental down here. I hope that no one misses anything, but that's just the way it is usually. Okay, so 389 minus 231, and this the incremental allowance could easily be a separate table. So overstatement 1 minus overstatement 0 minus 1. Let's to get the factor. Did I get that right? 389, 231. Okay. 50.58. And coming down here, we're not going to actually need this next one, but we'll do it anyways, just for fun. So 533. Oops. 11 with 0.44, 0.44. Oops.
Yes.
Okay, so let's say get the factor, and again, you know, if I ever write a book, it'll have those. Just have a table with those right on it. You know, to do this weird calculation. Anyway, coming up here, the question is, which ones get included in that incremental allowance down there? Which ones are we going to include in there? A question mark there. This one doesn't matter because you know, it's not misstated, and even if you did put it down here, 0 times any factor is going to be 0. So no, this one is not in there. This one, you'll notice that the book value covered 200 of this interval. Right now, the fact that there is a misstatement in this means that there might be more. There's evidence that it could be misstated by more in there. There could be more things wrong in that interval. You know, this only covered $200 of the $5,000 interval. So there could be more things wrong. So this one will get included in the incremental. There could be more things going wrong. Now down here, even though this one was misstated, it covered the entire interval. There's nothing else in this interval that can be misstated. This covers the entire interval. So this would be a no. It's not going to be having incremental allowance because it's as bad as it can get. It covers the entire interval and it's off by $1,000. Can't be any worse than that. So there's actually only going to be one here in our incremental allowance. We always pick the largest one, and you know, this is the largest one goes first. So this is the largest one, and in this case, there is only one. Oops, oops, oops. Try this again. Okay, so we'll have 0.58 times 4,500. And again, in this case, there is only one, so it has to be the largest one. Uh, 2,610.
Yes.
So this will be our incremental allowance. But we don't need to use this down here. It's not and notice something here too, you know, the size of the misstatement matters. You know, if it's 4,500, this is going to be a bigger number. If it's, you know, 300 is going to be a smaller number, and so on and so on. So the size of the misstatement, how big is the misstatement? It makes a difference for this one. Okay, and all three of these together will give you the upper limit on the misstatement. How bad could it get, basically? $19,660. What you guys got? No. Let's see here. Let me add them up again, just in case I may have made a mistake here.
That's correct, I'm sorry.
Yes, okay, let's see. Okay, so this would be the upper limit on it. This is what it could be off by. Our best estimate is that it's off by this. This is our best estimate. But it could be off by as much as 19,660. The book value is 400,000, so we could debate whether this is material or not. They generally don't do that on the CPA exam. They don't. I don't think they ever have, to be honest with you, because it's a judgment call. You know. So is it material? It depends. And that's it for this, right? Okay. Question there? Okay. Let's say be back. Let's say 7:05. Okay, let's jump back into the chapter 7 handout. I want to add something to it. I think we stopped. Yeah, okay, I think we stopped here last time. And add this to the handout. I just realized it's not in there. Oops, let's try that again. Something's called fidelity bonding, or just bonding of employees with access to cash. Has anyone worked at a place where you're bonded? A lot of times if you're a cashier or something like that, they'll, if there's if you're a cashier, they'll bond you. Anyone who has access to cash, a lot of times they'll bond. Bonding is basically an insurance policy. That's all it is. It's an insurance policy. That if someone steals something, the bonding company will reimburse you for whatever they stole. Up to like $1 million or whatever the policy is. So bonding is just, this is just a so bonding is an insurance policy. So if someone steals $1 million, you go to the bonding company, say, hey, you bonded, they stole $1 million and they'll give you back the $1 million. Okay, so this is an insurance policy, but one of the nice things that they do when you have a bonding company is they will do background checks on potential people that when you hire a new person, you give them their name, their name and all those specifics, and they will do background checks on it. I had a friend that worked at a place where they had this, it was an accounting manager. Guy came in, real personable and all this stuff, and they hired him. They put him through the bonding company. The bonding company said, we won't bond him. You can hire him, but we're not going to bond him. And he had been convicted of fraud. It never came out in the interviews, but he'd been convicted of fraud, and he served a couple of years in prison. And so one of the things that bonding companies do is, one of the most important things they do is will actually do background checks on people. So, and they don't stop you from hiring, but they'll say, look, we're not going to bond this person because of this background. So one of the things they do is background checks. Okay. Now, does bonding mean that you don't have to, you have to worry about internal controls over cash? No. Bonding, again, is an insurance policy, but it does not mean that you don't have to look at the internal controls over cash. So if you're auditing somebody, you're auditing a client that say is a bank or something like that, or even just normal, okay, or even something that's just normal, a normal business that may have dealing cash, cashiers at grocery stores and sometimes are bonded. It does not mean that, okay, nothing bad can happen. That's not what it means. So you still have to look at all the internal controls and all that for whatever the operation is. It's simply an insurance policy. An insurance policy doesn't mean that you don't do your audit. All right. So test controls. And you generally do test controls to reduce the substantive testing. And we talked about that a little bit. So the testing controls, these are just tests. They're yes, no tests. These are those like we did. Oops. You know, approvals and all that kind of stuff. And you see if you can rely on the controls. So you plan them, you perform them. And a lot of times when you perform the test controls, you will evaluate or reevaluate the control risk. So you perform the test of controls and see what it comes out. And you recall that when we did the test controls in the practice statistical practice exam thing, there's a tolerable rate. You know, okay, if these are off by 5%, we're okay, or whatever. I can't remember what we did, what it was in there, but you'll have a tolerable rate that, okay, if the controls are not working for 5% of the time, we're okay with that. If it's more than that, then we're not. So, and you might reevaluate the controls though, maybe, you know, up or down. If you do all the testing, you don't find any problems with the controls, you might say, okay, these controls are actually much better than we thought. Okay. So you evaluate the control risk, and the controls can come in, the problem with controls can come in two different flavors. This one is that they were designed incorrectly. So design deficiency, designed incorrectly. And operational means that it was used incorrectly. They're being used incorrectly. So they're designed fine, but they're just not being used the way they should be. And a lot of times you'll find these by observation. You know, whether they're being used correctly or not. I think I told you when I was a kid, I worked at a bicycle shop, and they had us all working on this cash registers, and we would bring in the cash register, the tapes were really faint, so we would bring something up on one register and then hand to the customer and they say, well, I can't read this, and they bring up on another one, and we had no idea what we were doing. You know, we're 14-year-old kids, we never should have been touching cash in the first place. But anyway, you know, so the cash register was fine. The cash register was doing what the cash register is supposed to do, but we were using it improperly because we didn't know that whatever you rang up has to be in that cash register. We thought all cash registers do is print out receipts. Okay. Now, testing of controls relating to the relevant assertions. So testing controls relating to relevant assertions. This is something that you come up in multiple choice questions and stuff like that on the CPA exam. Now, you'll notice something that is a lot of times, you know, repeatable throughout the whole thing. And, you know, you can kind of, even if you're not 100% sure, segregation of duties is a pretty big one. Another thing that you'll see a lot of are reconciliations. Removing verification. These are usually reconciliations. So, even though these all look kind of, a little bit overwhelming, there actually aren't that many of them. They're pretty much the same. And some of them, these are all the ones that I think are just hilarious, to be honest with you. Things like pre-numbered. I'll tell you about pre-numbered documents, because it's kind of obvious that you would have pre-numbered documents and that they'd be serially numbered. They wouldn't be randomly numbered documents. So pre-numbered documents are all accounted for. So every purchase order is accounted for, every sales order is accounted for, and all that kind of stuff. But they still list these as pre-numbered, even though I don't know how else you would do it or why. But okay, let's look at some of the transactions that would be higher risk. So these are just kind of ones just kind of think about. Which of the following transactions would have higher risks? Anyone? Yep. Estimation ones are going to have higher risks. Let's do these in yellow. And non-routine transactions will have higher risk too. Both of these are higher risk. Estimation, of course, when someone's making an estimate, that is a more trickier one, because the numbers are not as exact usually. Okay. Auditors perform tests of controls. Oops. For all of the following except anyone? So they're doing test controls. They want to verify all these things. There's one of them on here they're not going to, I don't say that they don't care about it, but they're probably not going to do specific tests about it. Anyone? You can put it in chat if you want. No one. Okay, I'll tell you then. First one. We do not check that the controls are efficient. They might be very inefficient, but if they're working, that's fine. We only check for effectiveness. So we look to see if they're effective, and that they either detect or prevent material misstatements. Those are all things that we want it to do. And not that we don't want them to be efficient, but that's not part of our problem. Our problem is that we want them to be effective. And if they're inefficient, we'll tell the client if we come across that, but we're not going to look for it. Okay. Audit procedures used to test the effectiveness of internal control include all the following except anyone? B. To test the effectiveness. We do inquiries, we ask people, we reperform it, we do it ourselves. We inspect the documents, we also observe people. Simply getting an understanding of the control procedure manual is not testing. That's not seeing if they are effective. They may have a perfectly written control manual and nobody's following it. Because controls, we do all the following except. This one I don't think we talked about. You cannot simply rely on internal controls. This was a popular thing a few years ago. Now it's a number of years ago. Like, I say a few years ago, I'm talking about like, 15, 20 years ago. There used to be articles on auditing big companies, and they say, why are we even looking at these transactions? They have billions of transactions. If we just get comfortable with the internal controls, then we don't have to do any of the testing on those transactions. And of course, they found that is not the case. You do have to do the testing on the transactions to get a dollar amount. Tested controls don't give you dollar amounts unless they're off by. So, the idea was, though, there were, and I remember seeing articles on this about if the internal controls are working, everything's fine. And of course, we find out that is not true. So you cannot rely solely on internal controls. Okay. Effectiveness on ND side of internal control. Smaller clients will usually have weaker internal controls. For one thing, they have fewer people. They'll have to segregate duties if there are few people in the office. And you have to segregate custody of assets, authorization, record keeping. Now think about it. If you have an office that only has 2 people, it's impossible to segregate duties. So small companies usually have much weaker internal controls. Large companies, hundreds of people, easy to delegate out. You do this, you do that, whatever. The fewer employees you have, the harder it becomes. So the question is, well, how do you audit it then? Usually you focus on the owner, and hopefully the owner is involved in the business. It's in the owner's greedy self-interest to make sure that things are getting done, that all the cash is getting deposited and all that kind of stuff. Those things that you really want to have happen, it's in the owner's greedy self-interest to monitor that. And since they're there all the time, if they're an active owner, that's a big help as far as the internal controls are concerned. You say, well, can't the owner do something bad? And it's, yeah, but now you can focus the audit on one person. you can focus it on the owner, or if there's two owners or whatever. But if the owners are involved in the business, then you can just focus on the owners. Now you just look at all the owners' account, their interactions with the company. And that is it really simplifies things much more if the owners are involved. It becomes really hard if the owners aren't involved and they have weak internal controls, because then you really have nothing to go on. But let me write this in before I forget. I'm sure there's a better way to write that, but so hopefully the owners are involved. A lot of times they are. And if they are, then it's in their own greedy self-interest to make sure that things are getting done properly. And then you can simply focus on the owners. Okay, inherent limitations of internal control. This is one of the kind of misunderstood things. The best controls can fail. Okay, inherent limitations. The big one is management override. It has an E in it. So, and by the way, when you talk about fraud, a lot of times it's management override of controls. Very often that someone from up above. Well, you remember that at Anthony case we had where Mark Fleming, the guy that was running it, overrode the controls, told him, well, here, go find a bunch of income that doesn't really exist. That kind of a thing. When management overrides controls, it doesn't matter what controls you have, because management isn't following them. So overriding the controls is a big problem, and it's one of those things that a lot of times, virtually all the time, when you have financial statements that are materially misstated, large companies anyways, it's management override. That management has directed people to, ignored the controls and gone ahead and usually done something to the books. Collusion. Collusion between employees. This foils, this causes the failure of the segregation of duties. So collusion between employees, segregation of duty, so the segregation of duties will break down if that happens. I'll tell you one that's very common is accounting departments and treasury departments. Treasury departments handle cash. Accounting departments handle the record keeping. So when I worked at US Steel, just to make sure that we didn't get together, you didn't have someone from treasury getting together with someone from accounting and saying, hey, I can get cash, can you make it disappear? The treasury department was literally 10 miles away from the rest of the plant. So we're in the plant where the accounting department was in the plant. 10 miles away was the treasury department. So trying to keep people separated, so that you don't have these people getting together. And also at Navistar, when I was there, there was a case where someone was suing to get their job back, but they had basically a whole entire shift that made tractors. It used to be International Harvester, was making a tractor, and then was stealing a tractor every month, basically out of a plant. And they had 28 people involved. And one of the people involved was an accountant. And so, when you have 28 people, including an accountant, it's really hard to find it. It's really hard to find it. And it doesn't matter what the controls are. The controls are being overrun. So it doesn't matter what the controls are. Collusion will foil those controls. And the sad truth is there's not a lot you can do about it. And it's very hard to detect because you actually have people in their roles who are covering it. So it isn't like somebody looks at the sheet and says, hey, where's this tractor? You're not looking for the tractor because someone's covering for it. Okay. Less villainous are mistakes in creating the controls. And mistakes in using the controls. Like the cash registers. First of all, don't give 14-year-old kids, don't put them on the cash register. That's a management mistake. So mistakes in creating the controls and mistakes in using the controls. One thing you have to remember about controls are made by people. They're used by people. You say, well, what about the computerized one? The computer programs are made by people. Everything is made by people. So there's also going to be this human factor in there, that things can fail because people are involved. Well, how do you prevent that? Get rid of the people, but you can't really do that because they're the ones that are going to be using the controls. They're the ones that are going to be designing the controls and that sort of thing. Now, the limitations of these controls, though, these are limitations in that they can cause the controls not to work. And people say, well, what can you do about it? Nothing. It's a limitation of them. They have a limitation of what they can do. You say, well, can you make it illegal? Yeah. Murder's illegal, still happens. I mean, it doesn't matter what you, it's a limitation of it. And people are all, whenever they find some, fraud or something, they say, well, what can we do to make sure this never happens again? Nothing. Okay, so client's associate treasury director and staff accountant collude to embezzle thousands of dollars from the client. How could the situation have been avoided? Anyone? You guys are sleeping, I can tell. I'm trying your mics and hear you snoring. All right, this one cannot be avoided. That's collusion. It's a limitation of internal controls. Further back here. Exclusion, it's a limitation. Okay. Much more is left here? We'll do up through 9. We'll call it 9. This isn't too bad. Okay, the question is, what happens when you find a internal control deficiency? You know, who do you tell about this? And it depends on the size of it. Material control deficiencies and significant control deficiencies are given to management and the audit committee, and they are written. Now, here's a small point about the wording that you run into in the CPA exam. They actually focus on significant. And significant is less than material. So significant is less than material. The reason I say this is a lot of times in the CPA exam, they'll talk about something being material, or excuse me, being significant. By definition, something that is material is also significant. You know, it's kind of like saying if, you know, to be significant, the water has to be at least 3 feet high. To be material, the water has to be 6 feet high. Well, if the water is 6 feet high, it's by definition, it's still significant. You know, it's higher than it needs to be for significant. So materiality, if there's something that is materially, material weakness, it is also significant. A lot of the actual write-ups of the, you know, of the auditing standards will reference it being significant, and that also includes material. It doesn't go the other way around. Things that are significant are not necessarily material. It's a lower level. Things that are less significant, if they're insignificant, generally you don't bother the audit committee with those. You can, sometimes they want to see them, and it can be written or orally. So if something's insignificant, you can tell management and not by the audit committee. The audit committee sometimes will want to know everything, you know, all deficiencies, but and if they do, you can give it to them, but generally you don't bother them with the small stuff. You don't bother them with the small stuff for a couple of reasons. First of all, you don't want to just bother them anyways, and then second of all, you don't want to have them focus on something that's not significant. You know, so if there's something insignificant, you give it to them, they might think it's important. You know, okay, well, no, this isn't a big deal. This is, you know, a couple $100 or whatever it is, you know, that might be possibly at, you know, at risk that, you know, they shouldn't be focusing on it, but sometimes you give them something they might think that they should be. I think I'm going to stop right there because this other stuff is actually kind of a different different thing. When I want to these two here that look very not assuming, these are actually kind of tricky. So we'll stop right here. Now, remember no class next week. Next week, no class, however however you want to say it. So no class next week, so I won't see you guys for 2 weeks. Then we come back, we'll finish up this handout, obviously. But we'll send out that sampling exam, and you should be getting that within like a half hour class. And have a good break. And I will see you guys in 2 weeks. What is that, the 29th? See you guys on the 29th. Okay? All right. Good evening.